The Chamber of Petroleum Consumers, COPEC, is forecasting a marginal increase of 7 to 13% in petroleum prices during the first pricing window of August 2023. The rise is attributed to the current increase in the price of crude oil on the international market. COPEC wants a review of the government's gold for oil policy, which was introduced to help reduce fuel prices. Citi News' Daniel Sakiti has more in this report, read by Charles Osukumi.
The government's Gold for Oil program, launched with the arrival of about 40,000 metric tons of diesel valued at $40 million on January 15, 2023, aimed to reduce the impact of exchange rates on fuel pricing. The policy used gold instead of the US dollar to import petroleum products with the goal of stabilizing fuel prices. Initially, the program led to a reduction in prices of fuel at the pumps, but from the second pricing window of April onwards, prices have experienced marginal fluctuations at periodic intervals. Currently, a litre of petrol sells at 12 cedis 40 pesos, while diesel sells at 12 cedis 45 pesos at leading oil marketing company GOIL. COPEC anticipates that the first pricing window in August will witness a 7 to 13% increase in the price of petrol and diesel. They also suggest that a Gold for Oil program should be reviewed to enhance its effectiveness.
The indications we pick is that prices are likely to go up. For petrol, diesel, there's been an increase in price per metric ton on the international market by almost $140 from $820, $830. You are now about $960. That's a lot. The city has been relatively okay, but given the high cost of the finished product on the international market, there's a higher tendency that the pumps would adjust upwards by tomorrow. We are looking at between 7 and 13, 14% for petrol and diesel. LPG could do anything between 10 and 20%, depending on the OMC or LPG MC that you deal with. If you listen to proponents, they indicate that it was there to stabilize the currency. If that is the objective, it's done what it has to do. If those who also initially were saying it's there to reduce fuel prices, will still stick with that argument, I'm saying that it really wouldn't be able to do much when it comes to such bullish periods where prices are up globally. And so they would probably need to review. I have said that I wish the gold for oil was used occasionally when prices of the product is going up like this. If boss had a stock, they could flood the market and say, look, you don't need to import, we have enough, we can sustain the market for 6 weeks.
The National Petroleum Authority has announced that it has achieved its target of gradually increasing imports under the Gold for Oil program, now constituting about 50% of the country's total demand for petrol and diesel. After 6 months of implementing the program, the authority is currently engaging stakeholders to review its effectiveness.
The objective has been met. Gold for Oil, as we speak right now, is able to meet about 50% of the market demand, and the private sector is bringing the remaining 50% as was expected. And also the stocks have gone up to the level. And in terms of prices, there are competitive prices now. So it doesn't mean prices will not change, but the prices are competitive and they are at a level that they would have been higher if not for some of these interventions, especially with the exchange rate intervention. So as I said, the Gold for Oil program is actually hinged on using the gold purchase program, the Bank of Ghana's gold purchase program, buying gold and then liquidating into dollars to pay for our oil imports. So as I've mentioned, there have been discussions between the Bank of Ghana, the MP, and the private importers as to how to bring the entire oil market oil imports under the gold purchase program. So those discussions are ongoing, and everyone supports that if we are able to do this, then our FX exposure issues can be addressed. It also takes away the pressure on the Bank of Ghana to provide dollars through the reserves to the oil, for oil imports. So I think these are some of the changes that we anticipate should be made, and it will help to reduce the exposure on our oil markets.